In 2008, the entire world economy almost broke because banks forgot the most important rule. Don't lend money to people who can't pay you back. Let me explain how that happened. Think about how a bank normally works. You put your money in the bank. The bank takes that money and lends it to someone who wants to buy a house. That person pays the bank back slowly, month by month, with a little extra money on top. That extra money is called interest. The bank uses that interest to pay you a little bit for letting them use your money. Everyone wins. But here's the thing. This only works if the person actually pays the money back. If they don't, the bank loses money, your money. So banks are supposed to be really, really careful about who they lend to. They check if you have a job. They check if you've paid back money before. They make sure you're not asking for more money than you can handle. That's the normal way. That's the safe way. Now imagine a line of dominoes standing up perfectly. Each domino represents a part of the financial system. Banks, homeowners, investors, other banks. As long as everyone does their job, the dominoes stay standing. Everything works. But in the early 2000s, banks started doing something different, something dangerous. They started giving home loans to people who couldn't really afford them, people with no job, people with bad history of not paying back money, people who were already in debt. The banks knew these people probably couldn't pay the money back, but they did it anyway. Why would a bank do something that stupid? Because they found a trick, a way to get rid of the risk. Here's how it worked. Let's say a bank gives you a loan for a house. Normally, that bank has to wait 30 years for you to pay them back. If you stop paying, the bank loses money. That's risky. The bank is holding that risk like holding a hot potato. But what if the bank could sell that loan to someone else? What if they could pass the hot potato before it burned them? That's exactly what they did. The bank would give you a home loan on Monday. Then on Tuesday, they'd package that loan together with 100 other loans. Some of the loans were good, some were terrible. Then they'd sell the whole package to investors, big investment companies, pension funds, other banks, people all over the world. Now the risk wasn't the bank's problem anymore. It was someone else's problem. So the bank didn't care if you could actually pay the loan back. They already got their money. They could just make more loans, sell them again, and make more money. It's like setting up a domino and then walking away. You're not there when it falls. You don't care if it falls. So banks started handing out loans to everyone. They called them subprime mortgages. That's just a fancy way of saying loans given to people who probably can't pay them back. People with no income got loans. People lied on their applications and no one checked. Some people got loans where the monthly payment was low at first, but then suddenly jumped up after 2 years. People signed papers they didn't understand. Loans were given out like candy on Halloween. And here's the worst part. The people buying these packaged loans thought they were safe. Why? Because someone told them they were. There are companies called rating agencies. Their job is to look at investments and say how risky they are. They give them grades. AAA is the safest. It means almost no risk. Then there's AA, A, B, 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 and so on. The lower the grade, the riskier it is. These rating agencies looked at the packages of home loans and gave many of them AAA ratings. The highest grade, super safe, but they weren't safe. They were full of subprime loans, loans that were probably going to fail. So why did the rating agencies say they were safe? Because of math magic, and because they got paid by the banks. Here's the math magic part. The agency said, sure, some of these loans will fail, but not all of them. They're spread out across the whole country. Different cities, different jobs, different people. So even if some people don't pay, most will. On average, it's safe. That sounds smart, but it was wrong. Because it assumed that all these loans were independent. Like flipping a coin 100 times. Sometimes heads, sometimes tails, spread out, random. But that's not what was happening. These loans were all connected. They were all dominoes in the same line. And rating agencies had another problem. The banks paid them to give these ratings. If an agency gave a bad rating, the bank would just go to a different agency, so the agencies had a reason to be generous, to look the other way, to say things were safer than they really were. So these packages of loans, full of risk, got labeled as safe, and people bought them. Pension funds bought them. Insurance companies bought them. Banks in other countries bought them. Everyone thought they were making a safe, smart investment, more dominoes, all connected, all standing close together. Now here's where it gets even messier. Some smart people on Wall Street realized they could make even more money off these loans. They created something called a collateralized debt obligation, a CDO. Imagine taking a package of loans, slicing it into pieces, mixing those pieces with pieces from other packages, and then selling the new mix as something different. You're taking risk, blending it, hiding it, and selling it again. It's like taking a bag of candies. Some are good, some are expired and might make you sick. You mix them all together, put them in a new shiny bag, and sell it as premium candy. People bought CDOs. Then someone created CDOs made out of other CDOs. And then someone insured those CDOs with something called credit default swaps, which were basically bets on whether the loans would fail. The whole system became so complicated that no one really understood it anymore. But everyone kept buying and selling because everyone else was doing it. And prices kept going up. Housing prices went up. Everyone thought they'd keep going up forever. If you couldn't pay your loan, no problem. Just sell the house for more than you paid. Everyone wins. Except it was all built on a lie. The lie that housing prices always go up. The lie that these loans were safe. The dominoes were stacked higher and higher, leaning on each other, waiting. Then, the first domino fell. People started missing payments. It started small. A few people here and there. But remember, these were subprime loans. Loans given to people who couldn't really afford them. And many of these loans had payments that suddenly jumped up after 2 years. So more people missed payments. Then they missed another month. Then another. The bank would take the house back. That's called foreclosure. Now the bank owns a house. They need to sell it to get their money back. But lots of banks are doing this at the same time. Lots of houses for sale. When there's too much of something, the price goes down. Housing prices started dropping. Now people who bought houses as investments were stuck. They owed more money than the house was worth. Some just walked away. More foreclosures. More houses for sale. Prices dropped more. The dominoes started falling faster. Remember those packages of loans that were sold as investments? Now the loans inside them were failing. People stopped paying. The value of these packages crashed. Banks that owned these packages suddenly lost billions of dollars. In March 2008, a bank called Bear Stearns almost went under. It had to be sold for almost nothing. In September 2008, Lehman Brothers, one of the biggest banks in the world, collapsed completely. It just died. Now everyone panicked. If giant banks could fail, nothing was safe. Banks stopped trusting each other. They stopped lending to each other. If banks don't lend, businesses can't borrow money to pay workers or buy supplies. The whole economy runs on lending and borrowing. When that stops, everything freezes. People who had nothing to do with bad loans started losing their jobs. Factories closed. Stores closed. Regular people who worked hard and saved money watched their retirement savings disappear because their pension fund had bought those safe investments that turned out to be worthless. The dominoes fell everywhere, across every industry, across every country. The whole line came down. In the end, millions of people lost their homes. Millions lost their jobs. Trillions of dollars in savings and investments just vanished. The economy shrank. It's called a recession. But this one was so bad, people called it the Great Recession, the worst economic disaster since the Great Depression in the 1930s. And here's the thing that makes people angry. The people who caused this, the banks and the executives who made billions handing out bad loans and selling toxic investments, most of them didn't go to jail. Some got bailouts. The government gave them money to survive. Taxpayer money. Your money. The people who did nothing wrong paid the price. The people who caused it walked away. Why did this happen? It wasn't an accident. It was a choice. A series of choices. Banks chose profit over safety. Rating agencies chose money over honesty. Regulators, the people whose job is to watch the banks and make sure they follow the rules, they looked the other way. Some rules were removed. Some were ignored. Everyone thought they were smart. Everyone thought they'd get out before it collapsed. Everyone thought the dominoes would keep standing just a little bit longer. But systems like this don't wait for you to get out. When they fall fast. And they take everyone with them. The lesson isn't complicated. When you build a system where risk is hidden, where no one is watching, where short-term profit matters more than long-term safety, the dominoes will fall. Maybe not today, maybe not tomorrow, but eventually. And when they do, it's never the people at the top who pay the price. It's everyone else. That's what happened in 2008. That's what can happen again if we forget.